Hi, welcome to your Jaeger review for the CPA exam, Business Environment and Concepts. In this video, we will be focusing on Area 5, which is Operations Management, and specifically Topic B, Cost Accounting. You'll notice that Section 5, Topic B, is divided into two subtopics. The first one, the focus of this video, is Cost Measurements, Concepts, Methods, and Techniques. And the second one is variance analysis, which we'll get into in a subsequent video. So let's get started. In this video, we are actually going to be focusing on the CPA Blueprint representative task, specifically of apply cost accounting concepts, terminology, methods, and measurement techniques within an entity. Let's start by talking about the cost accountant. The cost accountant has a primary objective, and that objective is to compute the product cost for the financial statement presentation of the cost of goods sold, which is on our income statement, and then also ending inventories, which is on our balance sheets. It sounds easy, right? Well, sometimes things are not quite as easy as they seem. Let's take, for example, when you go to the dealership to buy a new car. When you walk out of the dealership, you know exactly what you paid for the car. That's easy, but that is actually called the sales price. That would be the revenues from the business perspective. But what was the cost of the car? What did it cost the car manufacturer to make that vehicle that you have purchased? That's really what this section is all about, determining that cost and navigating through some of the challenges and decisions that the cost accountant has to make in computing and determining that. I'm going to refer back to this concept of what did it cost to make the car as we go through the rest of this topic. But first, let's get into some definitions. I've used the word cost quite a lot already. It's time to go ahead and define what the word cost actually means. A cost is the amount of resources that an entity must forego in order to achieve a specific objective. It's measured in monetary units, of course. Monetary units is one of our accounting assumptions that you'll review when you're studying for your FAR, financial reporting exam. And note that a cost can be actual or it can be budgeted. Actual represents historical costs. They have already been incurred, and we know exactly what they are. Budgeted costs, on the other hand, represent expectations or future costs. One way to think about this is if you're driving down the road, actual costs would be everything you would see out of the rear view mirror. It's historical. It's already happened. You've already been there, done that, passed it on the road. Your budgeted costs are the future costs. It's everything out of the windshield. It's the expectation of what we have in front of us. Now let's talk about cost object. A cost object is anything for which a manager is trying to compute the cost and assign the cost to. Now this could be a product like the automobile that I have been talking about, but it doesn't have to be a product. It could be, a cost object could be a department, it could be a particular facility or one of our branch offices, it could even be a customer. Maybe I'm trying to figure out what it costs me to service a particular customer. Now we're going to get into some categories of cost. First, we're going to talk about direct versus indirect costs. Now, cost is either or. It can be direct or it can be indirect, but it can't be both. A direct cost is a cost that we can easily and efficiently trace to a particular product. So back to my vehicle or automobile example, I know what tires I put on a particular car. I know what steering wheel I put into a particular car or what radio. Those are direct costs. I can say these tires went on this car. I might even know very specifically what factory workers worked on this car. Those are direct costs. Indirect costs are still part of the costs of manufacturing that automobile, but they cannot easily or cost efficiently be traced to a specific or particular vehicle. For example, I paint all the cars and I put varnish on all the cars, and I have who knows how many nuts and bolts and screws, and I could probably figure it out. But the key word here is cost efficiently. I can't cost efficiently figure out exactly how much paint went on each car or varnish, and these are called indirect costs. Now, indirect costs could be indirect materials, like I was just talking about, or indirect labor, the supervisor who is managing all of the workers. It could also be factory overhead, sometimes just called overhead. So my indirect costs, I have to go through a very specific process to get those costs assigned to the product. What I have to do is I have to accumulate them into a bucket. We call that a cost pool. And then I have to determine how I'm going to take that bucket of costs and assign them to the different automobiles. That process is called allocation. And we're going to talk more about that allocation process in just a moment. But first, I want to focus on manufacturing versus period costs, sometimes called product versus period costs. So I've already said a cost is direct or indirect, right? A cost is also can be defined as either manufacturing, which is a product cost, or a period cost. It has to be one or the other. It cannot be both. So a manufacturing cost, which is a product cost, that's the cost of making a product. We have three categories of manufacturing costs. Those would be the direct materials, the direct labor. By the way, both of those are always variable, and they come into in the category of direct costs. And then the third manufacturing cost is manufacturing overhead or factory overhead. So again, the cost to make a product is direct materials, direct labor, manufacturing overhead. It's the cost of making a product. It is not the cost of research and development, marketing, selling, warehousing, servicing. All of those kinds of costs are called period costs. This is a very, very important distinction because how we handle those costs makes all the difference. Manufacturing costs become assets, and they sit on our balance sheet as assets until we sell the product. Period costs, on the other hand, hit our income statement immediately, and they affect our net income. Lots of companies have gotten in trouble by calling something that should have hit the income statement, by calling a period cost a manufacturing cost when it wasn't appropriate or legal for that matter. So let me give you a little bit more terminology, and then we can get into the flow of costs. Terminology-wise, prime costs are considered to be direct materials plus direct labor. Those are our direct costs, right? And then conversion costs would be our direct labor plus manufacturing overhead. So we have direct materials plus direct labor, that's prime. And then direct labor plus manufacturing overhead, that's conversion. So let's talk about the flow of costs. Just like the materials to build an automobile will flow through our manufacturing system, costs will flow through our accounting system. I want you to visualize this automobile manufacturing facility. And I want you to really think about there being three separate and distinct rooms. The first room is where we're going to just put all the materials. When our purchasing guy buys those tires and those radios and the windshields and the sheets of metal, it all sits in that first room as materials. It's just a pile of materials. It doesn't look like a car yet. We transfer those materials from the first room to the second room. And we're going to call this second room our work in process room. That's where we transform the materials from being piles of metal and glass and rubber, where we transform it into actually becoming automobiles. And so what do we do to those materials? we add things. We add things like labor, our workers, and we add things like overhead, electricity and machines, the depreciation of those machines. And we convert this pile of materials into actual automobiles in the second room, this work in process room. Now, eventually, we finish with those, that manufacturing process. And once we have a completed automobile that's ready to be sold, we transfer it once again to the third room, and that's going to be called our finished goods inventory room, where it's now ready to be sold to the car dealer so that you can go in and buy a new car. All of the costs that we incur in those steps, again, like I said, those sit on our balance sheet as an asset. We are building up that inventory. It stays on our balance sheet until we actually sell it to the car dealership. And then what happens is it becomes the cost of goods sold number on our income statement. Now, your textbook actually has a great visual diagram showing the process of moving these costs from one room, the materials room, to the next room, the work in process room, to the finished goods room, and then finally to our cost of goods sold. So let's take a moment just to look at that visual diagram together. Here's the diagram that's in your textbook, and these are the rooms that I was talking about. We have our direct materials here. The materials get placed into a work in process room. They convert, if you will, from materials into automobiles. This is where the manufacturing actually takes place. Then it transfers into our finished goods room. Finally, the vehicles are sold, and it ends up on our income statement as cost of goods sold. You can see here the flow of costs from a journal entry or accounting perspective. Notice that when we actually purchase our materials, so materials come in here, and then when they come out of this room, they go into the work in process room. When they come out of the work in process room, they go into our finished goods room. And then once they are sold, it comes out of finished goods and becomes part of our cost of goods sold. We're going to look at some specific examples of journal entries and how this process looks using debits and credits when we get into our next section talking about traditional costing. So traditional costing. Now that we have some basic definitions under our belt, let's compare and contrast the different types of costing methods, such as absorption versus variable, and process costing versus job order costing. Now, we're going to start with traditional costing, and that comes in three flavors, if you will. There's job order costing, process costing, and then operation costing, which is a type of hybrid. We're going to start with job order costing because that's actually the most straightforward. We'll use job order costing with a company when the jobs that we are trying to cost, when the cost object, they're very unique and individual from each other. And think about things like car repairs, even making movies. The cost of making one movie would be very, very different from the cost of making another movie. So again, job order costing is appropriate to use when our jobs are very unique to each other and they are very distinct from each other. So we already know that manufacturing costs include direct materials, direct labor, and factory overhead. The good news is that's not going to change. We are still going to use those three categories to identify our product costs. We also know that direct materials and direct labor, because they're direct costs, they can be easily and efficiently traced to a specific cost object. But it's time now to go back and talk a little bit more about that factory overhead, those indirect costs, and talk about that allocation process of how we actually do that. Remember at the beginning of this video, I said we have actual cost and budgeted costs. Well, when a company is making a budget, they are estimating the amount of cost that it's going to take in order to produce a particular product. They estimate not only the direct materials and the direct labor, but they're going to estimate that manufacturing overhead cost as well. And then they're also going to choose a cost driver to determine how they will allocate those costs. It could be physical units, so the number of units that they plan to make. It could be number of machine hours that they plan to use, or whatever they decide is an appropriate cost driver. There's no rules or regulations suggesting what the cost driver must be. However, a good cost driver is one that has a cause and effect relationship to the cost that's being measured. So, let's take a look at how those journal entries would look for that particular example. These journal entries are actually pulled directly from your textbook. So job order journal entries. In this example here, we have assume that a company is recording the journal entries for job number 128, which is a custom order motorcycle. Notice that we're using job order costing, and it's a custom order motorcycle. So that does seem appropriate. Remember, job order costing is the appropriate kind of costing that we would use when our jobs are very unique and distinct from each other. For simplicity, job number 128 is the only job that we perform in January. And once we receive the order and the specifications for the motorcycle, the journal entries look as follows. So we have the materials, and then we pay cash for them. And then we use the materials in the production. So what happens is we will actually, notice what's happening here. We're taking them out of that first room. We're taking it out of materials, and we're putting it into work in process. Taking it out of the first room is represented by a credit, and putting it into that second room is represented here by a debit. And then what happens is as we are working in that work in process room, we actually incur other types of costs. It's the process of converting those raw materials into that custom motorcycle. And so we have payroll. We are accruing payroll for our employees. And notice we're adding that to our work in process room. And then overhead, we are adding that overhead, and then that overhead includes things like the rent, insurance, depreciation, etc. It's the allocation of our predetermined rate that we talked about just a moment ago. We're going to add that as well. And so we've got debit our work in process, and then we're crediting our overhead, under or over applied overhead. And so what we are actually going to do now is look at the journal entries once the motorcycle has been fully manufactured. And so we are down here, we are taking it out of that work in process room, again via credit, and putting it into our finished goods inventory room via a debit. And then eventually the motorcycle gets sold, which means we take it out of that finished goods inventory and it becomes part of our cost of goods sold. So up until this point, all of the costs were sitting on our balance sheet in different types of inventory accounts. Not until it's sold does the numbers, do the dollars transfer and they convert from being assets to being expenses. It comes off of our balance sheet, out of the asset section, and into our income statement, part of that cost of goods sold. And we go ahead and record the revenues and the accounts receivable for that revenue. Now, life would be good and the story would end here if our overhead costs were exactly $1 million and we did in fact produce exactly 500,000 automobiles or motorcycles. But we know that actual and budgeted are two different things, and the two very, very rarely match each other. So what happens is at the end of the day, we end up with this manufacturing overhead account, and we've either got too much in there or too little. And we call that under or over applied. And the next journal entries show us what we actually do with that under or over applied. There's two different ways that we can handle that. And it really comes down to, is it immaterial or is it material? Those are really important words that you need to watch for when taking the exam, because how you handle that, taking care of that under or over applied, is directly related to whether or not the amount of the under or over applied is material or immaterial. So the easy one first, right? If it's immaterial, meaning it wouldn't make a difference to someone who's making decisions after reviewing the financial statements, what we're actually going to do, if it's immaterial, is the essence of what we call write it off. We're just going to charge it to cost of goods sold. So if we've got a debit balance in our overhead account, we're going to zero it out by putting a credit. If we have a credit balance in the overhead account, we'll zero it out by making it a debit. We're going to do whatever we need to do to bring our overhead account to zero, and the offsetting piece of that journal entry will be to charge it, if you will, to cost of goods sold. Done. End of story. Simple. Complete. But what if it is material? What if the balance is really big and we have to handle it with kid gloves? We have to do something extra. That's what this next journal entry actually shows us. Option 2, when it is material. We still need to get rid of the balance in that account. That's not negotiable. So we still need to, if it has a debit balance, put a credit to bring it to zero. If we have a credit balance, go ahead and do a journal entry with a debit, bring it to zero. But what about the offsetting piece? It's not as simple as just, well, just write it off to cost of goods sold. Instead, what we actually have to do is a prorated journal entry where we take that balance and we appropriately and proportionately split it between these particular accounts. Notice we're splitting it between work in process, finished goods, and then cost of goods sold. So again, work in process, finished goods, and cost of goods sold. We have to figure out the proportional amounts and charge each one accordingly. So let's just say that our work in process had $3 in it, finished goods had $5 in it, and cost of goods sold had $2 in it. The sum of all of them equals 10, right? I'm just trying to do simple math here for you. So 3, 5, and 10. That would mean 30% of the balance would go in the work in process, 50% in the finished goods, and then that final 20% in cost of goods sold. That's what I mean by a proportional allocation of that balance, so that we can accomplish the goal of bringing our overhead account to zero, which is what we need to do, and that we do so appropriately when it's material. So once again, immaterial, write it all off to cost of goods sold, easy. Material, you need to do a proportionate allocation between the accounts of work in process inventory, finished goods inventory, and then cost of goods sold. All right, do we got that? Perfect. I think now would be a great time to maybe take a pause and look at a couple of the questions that we have related to this particular section and topic. What do you think? Let's start with question 54. Which of the following is assigned to goods that were either purchased or manufactured for resale? Our choices are relevant cost, period cost, opportunity cost, or product cost. Take a moment to think about that and answer that question. Hit pause on your video if you need to. Hit resume when you're ready to check your answer. So the correct answer here is product cost. In the solutions, you'll find the answers not only telling you what the right answer is, but why it's the right answer, and maybe even more importantly, why the wrong answer is the wrong answer. But let's take a moment to talk about that. Relevant cost actually does not apply here. A relevant cost is the cost that we actually consider when making a decision, when making particular management decisions about make or buy or insourcing versus outsourcing. A period cost are costs that are not associated with making a product, and it specifically tells us in this question that it's a costs that are assigned to goods that are manufactured, which means made for resale. That means it's a product cost. Manufacturing costs are product costs. It includes direct materials, direct labor, and then factory overhead. And by the way, opportunity costs, those costs represent the next best alternative. Hopefully you got that one right. It wasn't really too difficult. Let's take a look at the next question. Let's take a look at number 55. Now this one's quite a long one, and what I recommend when you're looking at a question that's long like this is start at the end so that you know what the question is that's being asked, and then you can read the question in context. So we're going to skip right down here to the end, and it says, what amount should management budget for cost of goods manufactured? So immediately your approach to this question should be, all right, how do I compute cost of goods manufactured? Now, cost of goods manufactured is going to be computed by adding up your direct materials, your direct labor, your manufacturing overhead, any beginning balance and work in process inventory, and then subtract out any ending balance in work in process inventory. So if you know you know what's being asked and you know your formula, you can actually read your question in context and then decipher it through. So let's do that. Let's go ahead and read this question in context. It says, in the past, 4 direct labor hours were required to produce each unit of product Y. Let's go ahead and bring this up a little bit. Material costs were $200 a unit. Ah, there's my direct materials. The labor rate was $20 per hour. And factory overhead was 3 times the direct labor cost. In budgeting for next year, management is planning to outsource some manufacturing activities and further automate others. Management estimates that these plans will reduce labor hours by 25%, increase the factory overhead rate to 3.6 times the direct labor costs, and increase material costs by $30 per unit. Management plans to manufacture 10,000 units. What amount should management budget for cost of goods manufactured? So what we actually need to do here is take the information that's given to us about materials, labor, and overhead and figure out how we're going to add them up together. It tells us in the problem that the materials were $200 each, but it was going to increase by $30. So our new direct materials cost is going to be $230 per unit. It also tells us that it takes 4 labor hours for each unit, but that it was going to increase, and it was going to be $20 an hour. Actually, it tells us that it currently takes 4 hours to manufacture each unit, but because we're going through an automation process, we're actually going to be able to reduce that by 25%. And so you notice It was 4 hours. We're going to reduce that by 25%, so it's only going to be 75% of that, and times $20 per hour. So we've got 4 hours. 75% of that means it's only going to be now 3 hours, and then we're going to multiply that by $20 an hour, and that's how we get our $60 per unit. It also tells us in the problem that our overhead would be 3.6 times the amount of labor. And so if labor is $60, I'm going to multiply that by the 3.6 times, and that's where our $216 of assigned overhead comes in. So the cost of goods manufactured is going to include direct materials, direct labor, and manufacturing overhead. So if I add these three together, 216 is my manufacturing overhead, plus my labor of 60, plus my direct materials of 230. That means it's going to cost me $506 to manufacture each one of my individual products. It also tells us in the problem, that's my 506 here, it tells us that we plan to manufacture 10,000 units. So if I take 506 and multiply it out by 10,000 units, I would get cost of goods manufactured at $5,060,000. That is the answer to the question of the amount of how much should I budget for cost of goods manufactured. Hopefully going through these topics and looking at a few practice and review questions has helped you better to understand some of these concepts here in Area 5, Topic B, and look forward to seeing you in another review video soon.